Hey everybody, happy Tuesday. Thank you all for joining. As we've known sorry, audio is working. That's good. Market's weak to be expected, and there's a lot of reason for that. More dark clouds. But let's just jump in. Today we're going to talk about some weird stuff, as usual, on-chain, crypto. But we're going to touch on commodities as well, because the reason is Bitcoin is probably a commodity. So let's learn more about what exactly commodities are and how we can use them as indicators of overall economic well-being, recession indicators, etc. So we have 32 pieces of knowledge to get through in about 20 minutes. That's about 37 and a half seconds a segment. So thank you so much, Ulrike. Penny, we appreciate you. Let's go. So as usual, now this is financial advice. Thank you all for being here. And we're going to start with the ugly. So I tend to start with where the most segments are, and the most of the news is actually ugly. But wait till the end, because there's some good pieces too. And my thingy is not working. Give me a second. Without my key, I can't do anything. Sometimes that happens. Live TV. Yes. All right, let's start with digital asset outflow. A record 423 million were drained from institutional digital asset holdings, and that is quite staggering. Just mostly Bitcoin, but let's dig into the detail of that. But that's nearly $500 million gone out of assets. So we saw that with some of the price action, although it's been relatively stable. But this is the breakdown. So the outflows here, you can see, we're mostly focused on Bitcoin. That was 453 million, and big money into short Bitcoin after last week it launched. And in addition, you can see things like Solana were flat, Tron were flat, Polkadot a little bit, Cardano $800,000. But Ethereum broke the mold of the last 12 weeks, where it's been drained every single week. Money flowed into Ethereum. Nearly $11 million. So that's good. It's still down nearly $500 million, which is equivalent to the amount that drained out of Bitcoin in this week, year to date. So that is the follow the money segment. So let's talk about Bitcoin. You can see here, this is the real Bitcoin daily volume from Arcane Research. And the Bitcoin spot trading activity is in the toilet, I'm afraid. And over the last 9 days, it's down from about 9 or 10 billion on June 19th to about 3.8 billion yesterday, which is a 60% drawdown approximately. That is not good. So obviously, when things like this happen, it means Bitcoin is going no bid. Investors are cautious. They're hanging out. They're waiting, kind of like a little bit like me, waiting to jump in. And it gets a little bit frightening. But to be honest, there are more clouds than sunshine on the horizon. So we're taking our sweet time. So now everybody's talking about recession. A lot of people have been talking about it, but you got Kathy Woods coming out on TV today talking about recession, and some other people. So Wall Street ends sharply lower as consumer pessimism stokes recession fears. A huge sell-off today. Dire consumer confidence. I think I covered it 2 or 3 weeks ago that the University of Michigan study was in the toilet. All-time high lack of consumer sentiment. And there is worries, obviously, the Federal Reserve's aggressive battle against inflation will tip the economy into recession. That's the big worry, but if anybody knows their stuff, they should know about this. It'll be kind of priced in. But we do know that stocks will be hit over the next couple of weeks until we hear from the Fed and exactly what their tone is. Apple got hit hard today, Microsoft as well, all fell down real bad. So let's talk about commodities for the first time in this video. And a lot of people that know macro and know recession indicators look to Doc Copper. Doc Copper is a nickname for copper, the metal. It is typically a leading indicator of impending economic downturns because it is used in electrical, industrial, transportation applications. Also with the advent of EVs, a ton of copper is needed. So we'll see. But according to this chart, you can see it's attempting to break down below that 15-month support where the number 1 is, the little blue arrow. And this could lead to support to the prior double top resistance or potentially as low as 2. 2.02, that blue line beneath the one line of 3.3. So we don't know where we're going to go, but historically, when you have this type of double top, those two double tops, one in 2006, 2008 before the Great Depression, and then one again in 2011, 2012, and we have the other one happening now, 2021, 2022. So it does look a bit ominous, but again, a lot of people argue there's such a need for copper with the growing electrification of the world that this is not possible, but we'll see. We'll see if it's a big decline. And we'll talk more about other commodities in a moment. So let's talk about Peter Schiff here. He tweeted today, every time the economy enters recession, it takes a larger dose of monetary stimulus to get it out. And that's because the stimulus prevents real solutions from taking place, etc., etc. But this recession will now require a fatal overdose of stimulus. So Peter knows his macro. I know he's very pro gold, etc. Let's not talk about Uganda news about maybe gold supply doubling on Earth. Imagine if we woke up one day and somebody said, hey, there's 42 million Bitcoin. That would really impact the Bitcoin price. But the news hasn't impacted the gold price. It still is, that 18, 20 level, which has been like that for 11 years. Anyway, we'll see. But I do agree with Peter here. He senses more stimulus, more quantitative easing, despite the fact we are in a little bit of QT net right now, which I'll talk about in the next slide. This is what QT looks like. They started a month or so ago, and it's very, very small. That is the actual money supply, the Fed balance sheet, and how it has increased since March 2020 with that little gray recession line, and how it is beginning to teeter off. But the question is, how far will it be cut back? And that is the $1 million, $100 million, $1 billion question that we need to ask ourselves. Now let's talk about some of the bad news. The bad news is less bad than the ugly news we just covered. So let's jump in. So Bitcoin is the worst performer in June when compared to large, mid, and small cap cryptos. Bitcoin lost 35% of its value in June, which is pretty staggering. And all indexes have outperformed those. So there was a theory that, with this risk-off approach, everybody would kind of ditch all their altcoins, large, medium, and small, and pump it into Bitcoin, and Bitcoin dominance would shoot through the roof. But no, that hasn't happened at all. So the Bitcoin dominance, I think, is now around 43%. And ETH has been underperforming, but it has gone up. It has actually outperformed Bitcoin a little bit over the last week. So let's go a little bit further. Let's talk about Bitcoin dormancy, a little bit of on-chain news here. And a big thank you to the people at Glassnode that prepare this beautiful data. But this dormancy flow is kind of interesting for a few reasons. First of all, the asset Bitcoin is obviously trading below its fair value, as hodlers, including long-term ones, are kind of liquidating. And this is generally the case when the oldest coins are being spent. It's kind of the whole dormancy thing. It's when the hodlers stop spending and reverse buying behavior. That is the key reversal to watch for. So if you look at this chart, I added a little gray thing saying a decade low. It actually technically is an all-time low because the data from pre-2010 was kind of not really analyzable enough because there wasn't enough of it. But this decade low dormancy flow is interesting, and now we have to wait and watch for that to peak up. Every time in history it spikes down, it tends to reverse course very quickly. So we're going to keep an eagle eye on this little orange wick down, and when that turns, that means we could be done selling. So, and pivot back up. So we'll see. Let's talk about network activity. So this is the Bitcoin network falling asleep. If you look at all of the Bitcoin network data, you have the fees per day down 30% just compared to a week earlier. You have fees as a percentage of revenues down. You got daily transaction volumes down 52%. You've got average transaction value down 50%. It is just all across the board. And part of the reason for this is high activity obviously increases when the market crashes, and as the market participants scramble to get out of their positions. Then there's a quiet piece, and this is when the price stabilizes, the on-chain activity drops to extremely low levels as people lose interest. And that's what's happening right now. People are kind of sitting on the sidelines, enjoying the summer, having a good old time. I hope. And the average transaction value is really staggering of how this fell here. So that is the Bitcoin network update. Now let's talk about Ethereum versus Bitcoin, because we touched on the on-chain volume. This is kind of staggering here. So the on-chain volume for Bitcoin is still $600 billion versus Ethereum, which fell to $199 billion in May 2022. Remember, as a comparison, in May 2021, ETH was at 670 billion. So the ETH on-chain volume is 29% of what it was 1 year ago. That is staggering, ladies and gentlemen. So the ETH is kind of shoveling up. But as the transaction fees go down, the transaction volume goes down, so does the average transaction fee. So the chain is becoming less busy and fees are down near summer 2021 levels. You can see that the average fee is down around 10, 11 bucks, which is good for those who want to transact on the actual chain itself. But nothing like as busy as it was a year ago, as illustrated with that data. So this is another chart, on-chain chart from Glassnode. A big takeaway here is it compares the Bitcoin supply last active 1 year ago in orange, and that was about 64.924%, call it 65%. And blue is the supply last active 2+ years ago. You can see the blue line has been flat ever since about mid-2020, and the orange line has been undulating up and down. So the key takeaway, the way to interpret this chart here is the hodlers, typically those 2+ years, have not moved anything or much over the last 18 months in that cohort. So it's a stable supply. But the orange folks have. So again, we need to watch the blue line carefully, because if the long-term holders start capitulating and selling, that is a very bad sign. So again, like the other orange wick we'll watch this little blue line here as well. So let's talk about consumer sentiment. Consumers out there are railing against inflation. Every time they go buy gasoline or some food or whatever, they are being smacked in the face, and they don't like that. And this is crushing consumer sentiment. This is from Michigan consumer sentiment study, which is the best of its kind, and we're crashing to an all-time low. It is extremely bad, and that is impacting everything in the economy. When the sentiment is so low, people don't rush out and buy stuff. They stay at home and save, maybe wait to buy the dip or something on Bitcoin. So this is from Andreas Steno, who was on Real Vision. And it was kind of a cool analysis that I wanted to share with you all. He basically spoke about how every time there was like a pump in the S&P 500 up to a certain level, it sold off. And that's where the little gray arrows are pointed to those pumps. One middle of January, towards the end of January, then again in April, then mid-May, and here we are, running up a little bit after a little bounce in June. So odds are, closer to month end, this is when the sell-off begins, when equity allocations get reshuffled around, and that brings a bit of downward selling pressure. We saw some of that in the stock market today as people were reallocating to other assets. So we see this could bring about a couple of buying opportunities as well. Over, early July event, low volumes, summertime. US has a thing called the 4th of July weekend. There's a thing is on a Monday, stock market will be closed. People will be kind of taking a vacation during that time. And that could be a good time to maybe take advantage of some good prices and some good names like Tesla. So let's look at some other historical chart. This is fintech stocks versus crypto stocks. And a big thank you as well to having a slipped my mind. It'll come to me in a second. But somebody share this with me. I can't remember. I'm looking at too many numbers. Okay, but you can see here that the fintech stocks since December 2020 have lost more than Bitcoin has over the same time frame. And that includes names like PayPal, Square, and others that are completely smashed. And the interesting thing to think about when you look at this is, one seeks to change and disrupt the traditional financial service system using existing payment rails like PayPal. And the other one is Bitcoin that wants to change the financial system by creating brand new payment rails. So the question is, who will win out? And so far, Bitcoin is performing better than fintech stocks. But the fintech stocks are now trading at extreme values out there. So let's talk about another one, Berkshire Hathaway, that has a very large percentage. Brickhouse, I remember the name Brickhouse. Thank you for sharing the previous slide. This is from Jim Bianco Research, and it compares the Berkshire Hathaway performance against the S&P 500 over the last 27, 28 years. And you can see that the Oracle of Omaha, Warren Buffett, has underperformed the S&P 500 since 1998. So decades are lost, and nearly half of their portfolio up until they started buying Occidental Petroleum was financial services, like traditional banks, and they have not been doing well over the last 2 decades plus. So watch. If you hold Berkshire Hathaway, be careful. Let's talk. This is from Kathy Woods. Thank you to Sanjay for sharing it. I remember you sent this one in. It's an ARC analysis report out to 2030 and the expected AI spend and how it'll increase human output. Now, I have it in the bad category because I do believe AI will get rid of a lot of traditional jobs. We're already seeing that happen in many places, even in different types of stores. But the 2030 AI spend will be about $14 trillion. And the labor output increases from AI software will go up to $56 trillion. So basically, the 14 trillion investment will bring about a 4x productivity in human productivity, but it'll also probably get rid of a lot of other jobs too. So depending on how that human productivity is measured, it could mean layoffs for certain categories of workers down the line. So be careful. Do not be in a job that can be replaced by artificial intelligence down the line. Now, a little bit of good news. Let's jump in. This is the Big Short investor, Michael Burry. He suggested that the Federal Reserve could unexpectedly reverse course in its planned series of sharp interest rate hikes due to an economic phenomenon known as the Bullwhip Effect, which is the name of this video. And I found this to be fantastic. I know what the Bullwhip Effect is, but to have Michael Burry come out and say, hey, the Fed is going to reverse itself on rates, cut rates, and stop QT was kind of shocking. And his whole thesis is the fact that he believes that there will be deflationary pulses from this, i.e. disinflation in the CPI later this year. So I have this in the good news category because obviously getting away from quantitative tightening and moving to a dovish stance, i.e. reducing or stopping the hiking of interest rates, will help the markets a great deal. So a quick reminder for those who don't know what the bullwhip effect is. Let me try to do an illustration. It's when you crack a whip and it swirls like this, but as it goes towards the end, the swirl gets bigger. So imagine somebody, a customer says, I want to buy 100 washing machines or whatever, 100 things of toilet paper or hand sanitizer, who knows what. The planner gets the message and they add a little bit. Then the buyer gets the message and they add a little bit more to the order. And then by the time it gets to the suppliers, they build up scale to create a whole bunch of production. And that is the bullwhip effect. And this is a distortion of demand, and it will bring about a huge amount of increased volatility. It's made an absolute inventory headache for stores like Walmart and Target and Costco. They have way too much inventory right now, so they're going to have to cut prices to get rid of all of the excess inventory that they built, that the suppliers have built, and this is the problem. So there will be an excess of product, and retailers need to dump the excess in inventories, and therefore it'll drop prices. That's the theory. That's what Michael Burry believes, but that's one thing I do believe in as well. So kudos to you, Michael. Commodities in a bear market too. Let's look at this one. This is other examples of price dropping, and these commodities are already, most of them are in a bear market with the exception of corn, oil, and sugar. Think food, which is good as the food prices are still kind of staying high. But if you look at nickel, it's 50% off its all-time high for 22 alone, not all-time high ever, just this year. Aluminium, 36.4% down, gas, 33.3% down, wheat, 26.4%, zinc, 22.4%, copper, 21.4%. Remember we spoke about copper earlier? Well, it's now in a bear market. And iron, 21.3%. So we'll see where this will go, but this is a good sign. But again, it takes time for inflation to weave itself out of the system. But again, it looks like things are cooling down. Not only are commodities cooling down, but home prices are cooling also. This is the U.S. National Home Price Index. For those of you waiting to buy your castle, with it has fallen not a dramatic amount, but about 0.6, 0.7% in a month, which is big, but we haven't even begun to see the big dips that are going to hit in June and May, because I know a lot of houses went no bid in May and have just been sitting there for like 6 weeks, and homeowners are dropping prices by 20,000 every week to try and offload their property. They're getting really nervous they're going to get stuck. So this chart you see here, I will pump it up again in about 6 weeks, 8 weeks, and I bet you we'll be down around the 18.5, 19% dip. So hang tight, everybody. Let's talk about another piece of good news. Well, it's very slightly good news, but the fear and greed index went up from 9 last week to 10. Not much, and the crypto market still remains very affected by the continuous flow of negative news and rumors related to different market participants. So it is nonstop fear, fear, fear all the way. And I can't remember the last time we've been down this low for a continuous period of time. I mean, we're here basically since, I think, the end of April or beginning of May, and it's shocking. So it must be 11 weeks at this stage. And Bitcoin price is still hovering around that 20,000, between, in this actual week, Bitcoin was between about 19.8 and 21.7. We're about $500 off that 19.8 level. A little bit of dip yesterday that's followed through a bit today. So next piece of interesting news. Uber and Lyft drivers are switching to Teslas because they feel the gas pinch at the petroleum station, the gasoline station, whatever you want to call it. And they are finding that they can make a lot more by driving a Lyft or Uber, the share pool ride thing. And it's a way more profitable option now than it was over a year ago. And in addition, I think Hertz car rental agency launched a partnership with Uber to allow employees to actually lease or rent Teslas. And I think 15,000 Teslas have been leased so far on this program by Uber drivers. So that's staggering. And that will help Tesla growth as well. Not that they need any help selling cars. Typically, it's 6 to 12 months to wait for a car. If you're waiting for a Cybertruck, you got to wait years. But this is the Tesla growth. Now, 2022 has been challenged in Q1. They only pushed out 310 million cars. Q2 2022 will actually be even more challenging because Shanghai was shut or limited production for a long time. But what we do have here, if you look at this chart, what makes it visually very interesting, and this is from Statista, you can see that, take for example, red is Q4 every year. You can see how as the year goes on, the later in the year, the more production they have. It's like they rush towards the sprint line towards the latter part of the year, Q3, Q4. And it's very similar to how software companies run their biggest quarters. I know most software companies, they sell 40% of their software in Q4. And it's not unlike Tesla here selling approximately 34% of their product in Q4 as well. So with Berlin and Austin coming online, we can expect a nice big round as they ramp up their own production too. So that was it, everybody. A lot of material, a little bit different today because I did want to talk about commodities and recession and inflation and pivots. The more, I've been talking about the pivot maybe by September, the latest, and now that narrative is snowballing. It's really gathering impetus when you get people like Michael Burry and Cathie Wood and Peter Schiff, all these people coming into the same page that the Fed might do something different because we are in a recession. Anyway, thank you all for being here. I will see you all tomorrow. Okay, thanks, and thank you to the moderators in the chat and everybody for keeping us safe. See you soon.